Alright everyone, Cowboy Trades here, welcome back to the channel for another update. So, it's 24 hours away until the next FOMC decision. Will Bitcoin and the SP 500 Nuke post FOMC? We're going to find this out in this video. We'll talk about the target rate probabilities, where I see the interest rates going to tomorrow based on Fed commentary, economic data and credit conditions. We'll then move on to a few charts discussing where I think the interest rates are going to top out in this cycle, and is this going to be as bullish for Bitcoin and the SP 500 as we think based on previous data. We'll then wrap up the video talking about obviously where I think Bitcoin and the SP 500 is going to, what are my price targets, all of that and more. Let's dive right into the video. So, starting off with the target rate probabilities, it's looking like there's over a 90% chance that we get another 25 basis point increase. If we come over to the spreadsheet for the meeting probabilities, it's looking like the markets are starting to think that 525 basis points or 5.25% for the interest rate is going to be where we're going to be topping out for this cycle. Markets are predicting that we are going to hold at this level for 4 months before cutting in November. Now, it might be worthwhile to note that coming into the next meeting in June, there's about 26.8% probability that we could get a further interest rate hike up to 5.5% for the interest rate. But let's take it one meeting at a time. Why do I think we're going to get a 25 basis point increase up to 5.25% for the interest rates? Well, let's start off with Fed commentary. What happened on March the 22nd? Well, we got that 25 basis point increase in the last meeting up to 5%. And what did Powell come out and say after the meeting? He stated that participants don't see rate cuts this year. Now, Powell's been saying this religiously, and the markets keep on pricing in rate cuts as the most probable outcome, but he's been proving them wrong for about a year now. You can see he said participants don't see rate cuts this year. Rate cuts are not in our baseline expectation. Rate hikes are well telegraphed, and many banks are able to handle this. You can also see Powell said we don't see progress on core service inflation, excluding housing. Inflation data, however, did point to higher inflation. Now, this is really what he's referencing. If we do come over to the core CPI index, last month this pushed up to 5.6%, going on a new rally. This really hasn't moved too much from its top up at 6.6%. And what's now interesting is you can see core inflation is eclipsing the headline inflation. Headline inflation right now is at 5% year over year. Core inflation is at 5.6%. When we see this, when we see core inflation eclipsing the regular headline inflation, this is a sign that inflation is becoming predominantly sticky. Now, sticky CPI, sticky inflation is something we've been discussing on this channel for a while. About 7 months ago, we were telling you, sticky inflation is accelerating and sticky inflation is going to persist. We talked about this 2 weeks ago as well. There's no update from the video 2 weeks ago, but you can see, if we do zoom in, for those of you who are new, the sticky CPI has just been on an absolute run to the upside, and this did come down from its all-time high in February, where the markets were around about 6.7% for the regular sticky CPI, and core sticky CPI was 6.6%. These have both come down 0.1% respectively. So we are seeing core CPI absolutely eclipse regular headline inflation, which is a sign that inflation is very, very sticky right now. If we move on to a few other reasons, while this is Fed commentary, this also links to credit conditions. Powell said this in the aftermath of the previous FOMC meeting. He said, right now we see the likelihood of credit conditions tightening. We don't know how significant or sustained the effect of credit tightening will be. That said, we think it's quite real, and this argues for being alert when we think of further rate hikes. Policy has to be tight enough to bring down inflation, and some of that tightness can come from credit conditions instead of continually raising the interest rates. And Powell also concluded saying the possible tightening in credit conditions may mean that monetary tightening has less work to do, basically reaffirming what he said over here. So instead of raising the interest rates with monetary policy, they can tighten credit conditions further. Now, how can they tighten credit conditions? They can do this in a few different ways, and they have been doing this since about Q3 of 2021 on most of these credit metrics. If we come over to the net percentage of domestic banks tightening standards for credit card loans, this basically shows us the tightening standards for domestic banks when they are considering lending money for credit card loans. Now, basically, when this goes on a massive run to the upside, tightening standards are increasing, meaning it's harder to get money, it's harder to get credit card loans. When it's dropping to the downside, credit is very cheap and readily available. You can see massive spikes have come in the 2000 financial crisis, in the dot-com crisis. We saw a massive spike in credit tightening conditions in the 2008 financial crisis, and we saw a massive spike in 2020 following the Black Swan event in March 2019. And once again, we're seeing credit conditions tighten one more time. So we know that the Fed is already tightening credit conditions right now. And as we talked about, these credit tightening standards have always correlated with recessions in the past. So definitely not a good metric. Later on in the video, we'll be talking about this chart over here with the interest rates and what happens with recessions after the interest rates do cut. But if we move on to our next chart, you can see the net percentage of domestic banks tightening standards for commercial and industrial loans to large and middle market firms. Once again, this is another chart for domestic banks showing us the tightening standards, this time instead of loans for credit card users. These are loans for commercial and industrial large and middle market firms. Now, when we do look at this chart, once again, you see a very similar picture following the 2000 financial crisis, following the 2008 financial crisis, and following the Black Swan event in 2019. You can see credit tightening standards increased, credit tightening standards increased, credit tightening standards increased, just like we saw in this chart over here. And also, these gray boxes on both of these charts show you when recessions took place in the United States. So basically, what you can see is when you have these massive increases in the credit tightening standards, recessions normally always follow as a result of this, or sometimes credit goes on a massive tightening spree and a Black Swan event happens, like in 2019, and we get one of these tiny data points. So right now, Powell and the Fed are currently talking about raising monetary policy even further, meaning more interest rate hikes. And with this, they're also saying we could tighten standards for credit. This would kind of subside and allow for less interest rate hikes in the future. But nonetheless, this isn't 100% a replacement. We can definitely witness both, with tightening standards increasing, just meaning that we might see a few less interest rate hikes than previously anticipated. Now, with this, like I said, when you witness these massive runs to the upside in credit tightening standards, recessions always follow as a result of this. And since Q3 of 2021, credit conditions have been tightening, and Powell is saying we need to tighten these further to fight inflation. But, you know, if we're looking at these sticky CPI metrics with core CPI eclipsing headline inflation, it's not looking like it's working at the rate that they're currently going at this moment in time. So, moving on from this, what is going to happen if the interest rate gets raised by 25 basis points? Obviously, we've just looked at a lot of commentary, economic data supporting the thesis that we could get a 25 basis point increase. What happened the last time this happened? Well, the market's absolutely nuked. If we look at what happened previously when we did have that 25 basis point increase, Bitcoin literally dropped thousands of dollars within a couple of hours or so. So I do think something like this could happen once again. I will be letting you know my price targets for Bitcoin, where I think we'll be going after this 25 basis point increase. But before we get to there, let's talk about a massive common misconception in the markets. A lot of people, not necessarily in the SP 500, more likely cryptocurrency people, which have been in the markets for less time than stock market traders, a lot of cryptocurrency people have this notion that as soon as the interest rates get cut, the markets are unbelievably bullish and we are just going to go on a parabolic run to the upside. And historically speaking, for Bitcoin and the SP 500, this is absolutely not the case. So let's talk about it. If we come into the interest rate right now, first of all, where do I think this is topping out? Well, I actually believe this could potentially be one of the last interest rate hikes that we do see throughout the rest of the cycle. So I, of course, do believe we get a 25 basis point increase tomorrow. I do think that that could potentially be one of the last interest rate hikes. I think that the interest rate is going to top out between 5.25 and 6%. So with that being said, I either think that this is the last hike, or we're kind of just setting up for the last few hikes before we top out round about 6%. Now, why 6%? This would be pretty much lined up with the past two tops that we've had in the interest rates, coming back to the 2000 financial crisis and coming back to the 2008 financial crisis, this would be pretty much running into exactly where we are right now, with the highs being at 5.25% in 2007 and the highs being at 6.55% in the 2000 financial crisis. I don't think we go that high though. I personally don't think we eclipse this data point. Although there's an argument for both. The bullish argument on the interest rates being that the interest rate could push up to 6%, 6.5%, and maybe even further, could be this trend line right here, where you can see previously, coming back to data points since the 1980s, you can see that we had a couple of touch points on this resistance line up here. We broke to the downside, and then we started forming this trend line in the year 2000. The interest rates topped out here. We broke down. When they next rised up, they got rejected pretty much on this trend line before breaking back down. And then coming into the 2019 crisis, we had that touch point once again on the interest rate. We had that touch point once again on this trend line before breaking down. This is a lot of previous data traded. In fact, this is 474 months worth of data traded, or this is 39 years worth of data. So needless to say, when you're seeing the interest rates breaking out of this massive trend line, it's definitely looking bullish for the interest rates, meaning interest rates could go higher. On the flip side, you could argue, hey, you know, the three major recessions which have happened in the past 25 years were the dot-com crisis here in 2007 and what we're witnessing right now. So if we do push up to, you know, 5.25%, we could top out and, you know, double top around about where the 2007 financial crisis is. What's interesting is both of these outcomes that I've just presented with you. Number one, the interest rates being bullish, and number two, us topping out around about these two data points. I find them equally as likely. So take them as you will. Let me know what you think in the comment section down below. But myself personally, I think the interest rates top out between 5.25% and 6%. I think we come into this red box. We hold here for a few months. If we look back at previous data points, you can see we held here for a few months. We held here for a very long time. We held here for a very long time. Bear in mind, you might be looking at this chart and thinking, hey, you know, we didn't spend too much time here. We're on the monthly time frame right now. So you can see this was a top in June of 2006, and we didn't start breaking down until August of 2007. Even in these minor data points over here, you can see we were up here in May of the year 2000. And we weren't coming down until December of the year 2000. If we come over to what happened over here, you can see the interest rates topped out in December of 2018, and they didn't start going down until June of 2019. So a lot of people are thinking that, you know, we're just going to go up and up and up, and then boom, just rush to the downside. This is the monthly time frame. You know, we are likely to top out and spend months at this region before, you know, having that drastic drop to the downside like we've previously seen. But at which point, if the interest rates get cut and we start moving to the downside, that's bullish, right? As soon as we get 25 basis points, Bitcoin is ready to rush to $200,000, $250,000, $1 million, right? Because that's what everyone says. As soon as the interest rates get cut, then the markets are bullish. Well, what you can see is we've actually got this green overlay on this chart, and what this shows us is the US recessions. This highlights all of the major US recessions that have previously happened, and as you can see, most of them happen when you have an interest rate cut. You have a rally to the upside, you start having cuts, recession. You have a rally to the upside, you have a cut, recession. Rally to the upside, cut, recession. Rally to the upside, come down for a few months, recession. Rally to the upside, top out in the 2000 financial crisis, come down for a few months, recession. Rally to the upside in the interest rates, top out in September 2007, come down to the downside. What do you know? A few months later, we're hit with the 2008 financial crisis. We have a brutal recession. Interest rates come all the way up into June of 2019. We break down, and coming into 2020, we have that recession. Once again, this may have been a black swan event, so take this with a grain of salt, but history is very clear, especially on this trend line that we've broken out of. When you have a rate cut, you have a recession, and we've absolutely smashed through this trend line right now. So if we do start lollygagging here and then have rate cuts, bear in mind we're having rate cuts from, you know, higher levels than we had in these two previous financial crises in 2019, 2020, and all the way back to 2008. So it may not be as bullish for the markets as people think. In fact, if we do come over to Bitcoin, then we'll look at the SP 500. You can see Bitcoin obviously hasn't been trading for as long as the SP 500. In fact, Bitcoin has only ever witnessed one time in 2019 when the interest rate started to get cut. And I've talked about this before. If the interest rates do get cut, then I will be short-term bullish. As you can see, the interest rates were cut over here, and Bitcoin went on a 54% rally on the weekly time frame, an absolute monumental run-up. In fact, if we do come over to the daily time frame and spot exactly the move, you can see, well, there you go. It was pretty much exactly what we told you. 52.25% rally as soon as the interest rate hike happened. And then the bull run happened, right? We were immediately heading up to 69K. Well, no, not necessarily. You can actually see after the interest rate hike, even if we draw from where the interest rate hike started, we had this rally, but then after that, we broke down 57% after the cut. And if you're looking at from the top of the rally, it was a 72% capitulation after we had the interest rate cut. So like I said, Bitcoin doesn't have that much data traded on it. We've only seen one interest rate cut. Yes, it was short-term bullish for how long? We're on the weekly time frame. This was bullish for 1-2 weeks, and then we nuked to the downside. So if history is any indication on Bitcoin, if we do get that 25 basis point increase, we will have a melt to the upside, and then we will nuke down into new bear market lows. For the S&P 500, I'll just quickly dive through this one because it is exactly the same. If we come over to the monthly time frame, I will highlight what happened with all of these major cuts in the past 25 years, and we'll also go back a few data points from that. So you can see the major cuts were these ones right here. And once again, if you want to go back further, you can. You can see I'm not omitting these data points because they don't fit a bias or something. You can see cut, breakdown, you can see a cut up here, breakdown. And if you go back further, you can see when we have these cuts and we have these recessions, they always cause major breakdowns in the market. So if we go back to the cut following 89, you can basically see in the immediate short term, so the cut was actually here, sorry. You can see we had a short-term rally, just like we have done in Bitcoin, and then we broke back down lower, creating this recession. Over here in the year 2000, you can see we had an interest rate cut. If we zoom in, zooming into the interest rates as well, you can see interest rates were cut. We had a bullish rally for 2 months, and then we nuked to the downside, and we had a recession. Because once again, remember, these green bars are US recessions. If you want an educational video on how to get this recession indicator, let me know in the comment section down below. You can see in 2007, interest rate cut, 3-month rally, breakdown, absolute nuke to the downside, recession. Over here, you can see interest rate cut in 2019, rally for about a year or so, major crash to the downside, and then a major recession. So if history is any indicator, most of the markets are absolutely wrong on this fact. A lot of people are hoping that we get an interest rate cut and then we're going to have a bull run. If history repeats, this will absolutely not happen for the market. So we've talked about where I think the interest rates are going to top out at 5.25% up to potentially 6%. But really, if you put a gun to my head and told me to, talk about a much more specific range, I'd say between 5.25 and 5.5% is where my money is on, meaning we've got about another 1 or 2 rate hikes to go. Could we have 3 or 4 up to 6%? It is potentially possible. So we talked about where I think we're going in the future with the interest rates topping out. We talked about why I think personally that we're going to get 25 basis points tomorrow based on lots of Fed commentary, economic data, credit conditions, etc. Now let's talk about in the immediate short term, what are my price targets for Bitcoin and the S&P 500? Well, I will dive through this very quickly because if you do watch my channel, you know that I have provided Bitcoin analysis in the past, 24 hours, talking about exactly where I think Bitcoin's going. We also talked about exactly where I think the S&P 500 is going in some of these most recent videos. 1 week ago, we talked about specific price targets. So for those of you who are new, I will update it. Bitcoin is right now at an absolutely monumental level of resistance. This was previous support, flipped as resistance. So if we do break down following that FOMC meeting, this is going to be a absolutely brutal rejection. Where do I think Bitcoin's going down to? There are a lot of price targets on the screen, which we talked about in our previous videos, but a very specific one I've got my eyes on right now, which I think we could go to very quickly after the FOMC meeting, is this mini CME gap that we have down here at 24,800. That means from where we are right now, Bitcoin could witness a $3,275 drop, or about a 12% drop down to, once again, just around the 25,000 mark. There's a lot of other price targets here that you may want to keep your eyes on. Head and Shoulders 23,400, a major CME gap down here at 20,300, and a bark pattern price target down here at 19,500. Where do I think the S&P 500 is going to? Well, there's not too much to update for the S&P 500. As you can see, slight push up to the upside. But if we do top out where we are right now, the S&P 500 will still be putting in this wave E beneath this wave C. Now, if the S&P 500 starts to exceed this previous wave, round about, 4,198, let's call it 4,200 for simplicity, then this Elliott wave theory will be invalidated. But if this is the top on wave E, we can just draw this out, and this will still be a lower high from wave C, this will still be a lower high from wave A, and this Elliott wave theory will be completely valid. So I'm still witnessing something like this to play out for the S&P 500. I do think that we are going to start breaking down to what specific price target for the S&P 500, right down here to this price gap. This is really a macro target at 3,580. This could be meaning in the coming months, the S&P 500 could drop a further 14%, almost down to its bear market lows. One final thing that I want to wrap up on very quickly is the Federal Reserve balance sheet. A lot of people have been talking about how this little bump in the markets over here in the balance sheet was going to be the start of quantitative easing, and we made numerous videos talking about, is QE back? Has the money printer returned? We of course debunked this. We looked at the pure definition of quantitative easing, which is buying bonds and securities back in the market. This is not quantitative easing. No bonds were purchased. You can see what was actually added to the Federal Reserve balance sheet was predominantly primary loans and loans from the swaps market with a high interest rate, which were going to be repaid. We talked about this in this video when we debunked it, and we talked about how this balance was going to start coming back down, and everyone talking about quantitative easing has just become quiet now. There are no longer any videos on quantitative easing as the balance sheet starts to shrink once again. So you can see we had a new data point on this on the 25th of April, and this is still coming to the downside. So quantitative easing is not happening. The money printer is not returning, and the Fed has been very, very clear on their commentary. They are saying that we're going to keep on raising the interest rates and we're not going to cut them this year. So for all these reasons, my friends, this is why I think it's very likely tomorrow we get 25 basis points. And based on the previous history, when we had our last FOMC decision, we got 25 basis points and Bitcoin absolutely nuked to the downside. So this is really what I think is going to play out once again. I think Bitcoin in the S&P 500 is getting ready to nuke to the price targets I highlighted in this video after we have the FOMC decision. So for today, my friends, that's all I've got. As always, if you do enjoy these videos, let me know down below by leaving a like and a comment, share the videos with your friends. I will leave a link to all the sources down below, including this meeting probability table. But like I said, for today, that's all I've got. If you do enjoy my content, let me know down below by leaving a like and a comment, share the videos with your friends. If you want to further support the channel, feel free to click the join button and become a member today. Follow me over on Twitter at 618_cowboy. It's been your boy Cowboy Trades. I'm out. Peace.